Okay, we're going to get started today. There is a question in Learning Catalytics right now, so you want to make sure you get logged in. We're going to be closing it as soon as I'm done with announcements for class. So, today what we're going to be doing is we're going to be covering Chapter 4 and 8, part of it, and we'll talk about that in a moment. What's due this Saturday? This Saturday is a little unusual because we have an exam next week. We have Chapter 4 and 8 homework. It is one assignment. The fact that it says Chapter 4 and 8 should not panic you like we have extra homework this week. We are doing one learning objective from Chapter 4. We'll do that today. And then we're doing only a little bit from Chapter 8. So it's actually a lighter week than usual. Even though it says 2 chapters, it's not 2 big chapters, it's part of 2 chapters. There's also an Exam 2 info quiz. This should be a very easy quiz. I think it's 5 multiple choice questions. It went up yesterday and it's due this Saturday. So this Saturday you have the Chapter 4 and 8 homework, it's one assignment, and the Exam 2 info quiz. If you're in Section 3 you also have a regular quiz. But the homework should be in my accounting lab now. After class I'll make sure it's there, but it was up when I saw it. It came up yesterday. But I'll check after class. So the practice exam 2 is due before you take exam 2. So practice exam 2, just like for exam 1 you had practice exam then, there's another one that came up yesterday, so you have that available. It is due before you take the exam. It's not due this Saturday. Again, you can do it as many times as you want. Your score on it will be the average of all your attempts. If you want to practice the material before you do the practice test, you can go into Study Plan and do it that way. You'll be able to access the same content in Study Plan. So that's up to you. So this week, this Saturday, you've got Chapters 4 and 8 homework, Exam 2 info quiz, and Section 3 has a regular quiz. Somebody just said how much is practice exam worth? It's out of 100. It's out of 100. Every quiz is worth exactly the same. I could have it out of 1,000. It's still your percentage score that counts. So every quiz is the same, worth the same, so practice exam counts just like any other quiz. Okay. There is, if you're just joining us in Learning Catalytics, Haley will put in the session ID, but there is a question out there to answer. We do not have class next week because of the exam. The exam is Monday, Tuesday, and Wednesday next week. You need to finish by 8 p.m. Sections 3, 7, and 8, you'll have to schedule with ProctorU ahead of time. If there's any problem when you're scheduling, like you say you can't see it, or you don't have it, you're not seeing a time slot or whatever, I would just urge you to pick up the phone and call them. You can call them, talk to them, and you get your question answered. So there is a 10-point bonus. This isn't recorded anywhere, but there's a 10-point bonus again if you take your exam on Monday, the day it's offered, and you have to submit it before 9 p.m. Eastern Standard Time. So it has to be completed before 9 p.m. That 10 points, you will not see it. I will add it Monday night or Tuesday morning. So when you submit your exam on Monday, it does not include the 10 points until I physically add it. When I physically add it, you'll see a little asterisk next to your exam score. Okay, now right now there is a question in Learning Catalytics, and I'm going to put the session ID up here. The session ID is 72706531. I want to write that down. The question is just a poll to find out what day you are most likely to take the exam. You're not committing to anything. So that Learning Catalytics question will be open for about 30 more seconds, so make sure you answer that question that's in Learning Catalytics. So now on to the material for today. Any questions about the exam or anything before we go any further? Okay. We are covering Chapter 4 today and part of 8. So Chapter 4, the reason I skipped it is because 8's a very small chapter. Chapter 4, we're doing one piece of it. There is one learning objective in Chapter 4 called Bank Reconciliations. Chapter 4 is about cash, about how you account for cash, and about internal control. Internal control is a system we have built in to protect our assets so they don't get stolen, so we don't misaccount for them. And one of the very biggest internal controls we have is a bank reconciliation. And a bank reconciliation is a way for us to make sure that we've recorded our cash correctly. There can be questions similar to Learning Catalytics. I'm answering that question. There's a question in the window. Do we need to study from Learning Catalytics for the exam? Do you log out of it completely? Okay. Do we need to study from Learning Catalytics for the exam, like there are any questions similar on the exam? Learning Catalytics, great questions. I mean, there could be similar questions, sure. You can always get in and review the past questions through Learning Catalytics. It would not be the focus of my exam preparation, but certainly should be able to answer all the questions we've done in class. Okay. Okay, so we're going to do a bank reconciliation. Bank reconciliations are a way we have to make sure that we have recorded all our cash transactions correctly and that everything's been recorded and it's been recorded correctly and that the bank hasn't made any errors as well. So first thing, I'm going to go silent for a little bit. This is a standard bank reconciliation form. I would absolutely positively have it on my sheet for the exam. So the basic bank reconciliation form, on the left-hand side are the bank adjustments. On the right-hand side are the book adjustments. So I'm going to go quiet for a minute or two while you write this down, and then I'm going to talk about each of the components. Okay, you can only use ProctorU. I'm going to go ahead and answer that. You can only use ProctorU if you're in sections 3, 7, or 8. If you're in sections 1 or 2, you have to use the computer lab. You can email me and I can answer any questions you have about that. But ProctorU can only be used if you're in sections 3, 7, or 8. Again, it's quiet because I'm waiting for people to write this down. Okay, we're going to start talking about this now. We're going to start at the top left corner. What we're trying to do is we're trying to prove that everything's recorded on the bank side and everything's recorded on the book side. Our objective is to make the two balances equal. When you get your bank statement, even if you're looking at your own checking account, if you get a bank statement, the bank statement, if you have a lot of activity going on, will seldom equal your checkbook balance. Same with corporations. They will never equal because of timing errors at least. So starting with the bank balance, you write down the balance the bank statement has. Then you're going to add deposits in transit. Deposits in transit are the deposits that you make at the bank after the cutoff for the statement. So when you go into the bank and there's that sign saying all deposits after 3 p.m. will be credited tomorrow, that's what creates a deposit in transit. You're in there at 4 p.m., you make your deposit in the bank, so the bank has it, but they're not putting it in their system until the following day. That's a deposit in transit. So you have to take the bank balance and add the deposits in transit they don't have. Deposits in transit is a very specific term. Then we have outstanding checks. Outstanding checks are checks we've written that have not been cashed yet. The bank doesn't have any way to know that you've written those checks until the customer or whoever, the supplier or whoever you've written the check to, cashes it. So outstanding checks are checks that we've written that the bank that have not been cashed yet. So we need to deduct those from the bank balance. And then if there's any bank errors, we may have to add or subtract that. But we get to an adjusted bank balance. So that's one side of it. The next side, we start with the book balance. The book balance is what's in our general ledger. After we've posted all our journal entries that we've written for the period, we have a general ledger balance. That's our book balance. Then we're going to add to that bank collections. Bank collections are collections the bank makes on our behalf. Sometimes when you pay a bill, sometimes companies will set up a lockbox. So you pay a bill and it goes to a P.O. box somewhere, not to the company. You're paying a bank and the bank is collecting on the company's behalf, and they can quicken their cash collections that way. You just send it straight to the bank, it's deposited, so it doesn't have to go through all the processes at the company. So those are bank collections we may need to record. Interest revenue. If we earn interest on our checking account, we have to record that when we get the bank statement. We don't know until we get the bank statement what that interest revenue is. EFT receipts are electronic funds transfers, so those are like wire transfers in we haven't recorded. So we have to add those. We have to subtract certain things. The bank may charge us a monthly service charge. We need to subtract that. We get our bank statement, we see the service charge on that. NSF checks are non-sufficient funds checks. These are checks that we have deposited and then the customer or whoever wrote the check doesn't have sufficient funds in their account, so the check bounces. So we get charged for it. So say we deposit a check for $100 from a customer, it bounces, so then we get charged the $100, and then we have to go back to our customer and say your check was bad. EFT payments, if we do wire transfers out and haven't recorded them, we have to record those. And then we add or subtract correction of book errors, and we come up with an adjusted book balance. When our bank statement's in balance, those two bottom numbers have to equal. That means that more than likely we've recorded all transactions, we've recorded them correctly. We only need to write journal entries for the book balance side. On the left-hand side, the deposits in transit, the outstanding checks, those are timing errors only. Deposits in transit, if we wait a day, they'll be in the bank. So next bank statement, they'll be in there. Outstanding checks, once they're cashed, they're already in there. So we don't write journal entries for the bank adjustments, but the book adjustments, typically we need to. What we're going to do now is we're going to do short exercise 4.9, which is a bank reconciliation. So what we're going to do is we're going to do that same form that we just did. So I've got this basic bank reconciliation form at the bottom. I don't have everything written on it because we don't have everything on every statement. So I'm going to pause for a minute if you want to write just those. Leave yourself plenty of room because we have a couple in the add box for each of them. But what we're going to do is we're going to go through and do this bank reconciliation. But the easiest way to do a bank reconciliation is start with the form and then start filling in numbers from what you're given. In this problem, it tells us, it gives us a series of transaction or information, and we have to do a bank reconciliation. So what I'm going to do is I'm going to start at the top, and every number I come across, I'm going to put in the bank reconciliation form wherever it goes. So we're going to start at the top. It says the cash account of this corporation reported a balance of $3,640 at August 31st. So what they're doing is they're telling us that we had on our books $3,640. That is the book balance. Okay? They're saying that's the cash account. That's the cash account on their general ledger had this balance of $3,640. Okay, so that's our book balance. Included were outstanding checks totaling $800. Okay, so outstanding checks, if we look back at our master plan, outstanding checks go down under subtract. $800, so outstanding checks, these are checks we've written but have not yet been cashed. And we put brackets around them because they're being subtracted. The next number over, an August 31st deposit of $300 that did not appear on the bank statement. So that $300 didn't appear on the bank statement, so that's a deposit in transit, so we're going to add that. So you have a deposit in transit of $300. Now, did not appear in the bank statement. The bank statement, which came from Tri-State Bank, listed an August 31st balance of $4,775. So they're giving us the bank balance. So that bank balance goes in the bank balance column, $4,775. Next number, it says included in the bank balance was an August 30th collection on $685 on account from a customer who pays the bank directly. So there we have some money going directly to the bank. So $685, that's a collection, a bank collection. So that's going to go in the add column on the book side. Now this customer paid the bank directly, so we haven't recorded it yet. So it has to go on our book side as an adjustment. The bank statement also shows a $15 service charge. So a service charge, so the bank is charging us $15, so we need to deduct a service charge of $15. Next over, we see $20 of interest revenue. So we've earned $20 interest revenue on our bank statement, so we're going to add in the interest revenue. And the next number we see is an NSF check for $55. So this is a $55 check that a customer has given us. We deposited it, and then the bank is rejecting it and says that the customer didn't have enough money, it's non-sufficient funds, so they're charging us. So we're going to have to deduct the NSF check of $55 there. And now we come to the end. There are no more numbers. So we have to come up with our adjusted bank balance and our adjusted book balance. So what we'll do for the adjusted bank balance is we'll start with the bank balance of $4,775, add our deposit in transit of $300, subtract our outstanding checks of $800, and come up with an adjusted balance of $4,275. And then we have to do the same thing on taking the book balance, adding the addition, subtracting the subtractions, and we come up with the adjusted balance, again, of $4,275. Okay, now the point in doing a bank reconciliation is to come to our actual cash balance. Our actual cash balance is $4,275. We've made all the adjustments to the bank side, all the adjustments to the book side, and we are said to be in balance. So our bank statement balances. Now the very next homework problem is related to this one, 410. Okay, so 410 says, okay, we have that bank statement, which is right there. So it's the same bank statement we just did. And 410 says, let's do the required journal entries. So thing to know here is on the bank side, we don't need to make entries for those. Those are timing errors only. Those bank things are deposits in transit and outstanding checks are things that will work themselves out just by sheer nature of being a timing issue. Deposit in transit, credited the next day. Outstanding checks will be deducted from the bank when they're cashed, so we don't make any entries for those. However, on the book side, those are all generally things that we need to write and journal entries for. So what we're going to do right now is we're going to do journal entries for each of these adjustments on the book side. So the book side of things are when we need to make the journal entries to make the adjustment. The adjustments we do here are pretty standard. I would have those listed somewhere. These are common entries for bank statements. Okay, so the first one, bank collection. The bank collection of $685, what we're going to do there is we got $685 cash. It hasn't been recorded yet, so we're going to debit cash for $685 and credit accounts receivable because we're reducing what a customer owes us. So the journal entry we have to make is recorded there. Okay, next item up there then is the interest revenue of $20. So this is interest we've earned that we have not recorded. So interest revenue, we're going to be debiting cash because we're getting cash in and recognizing interest revenue. Okay, so the next item down, service charge, $15. This is the bank is charging us $15, so we need to reduce cash and debit bank service charge expense or miscellaneous expense. So we're reflecting that we've been charged for bank service charge. And then the last one in this column is NSF check. An NSF check is a non-sufficient funds. It bounced, so it's being returned to us. This was a check that our customer had given us in payment. The bank's saying this isn't any good, so we're reducing cash, and then we're going to bill the customer because the customer now owes us the money since the check wasn't any good. So we're going to debit accounts receivable and credit cash. We had 4 journal entries. Those are pretty common journal entries for adjustments. Know that we only make adjustments for the book entries. These are the things that have not been recorded by us. We need to record them. We do not need to make any adjusting entries for the bank items, for the deposits and transits or outstanding items because they are timing errors only. What we're going to do now is we are going to do a question in Learning Catalytics. Capture on this one. Okay. So the question is, every adjustment on the bank side of the bank reconciliation needs to be recorded in the books. True or false? looking to see. Not looking over here, but I'll address that. I'll address it, but I would love to talk about that, why that's backwards. Okay. Okay, question in Learning Catalytics. Every adjustment on the bank side of the bank reconciliation needs to be recorded on the books. True or false? You have 5 seconds to get your answer in. Every adjustment on the bank side of the bank reconciliations needs to be recorded in the books. What that's saying is, do you need to write a journal entry for every adjustment on the bank side? 2 seconds. Okay, and that is false. The reason it's false is because we make the recording for everything on the book side. On the bank side, those are timing errors only, so they are not recorded in the books. Okay, in the chat window from Samantha was a question about bank debits and credits are opposite of what we talk about in class. And I wanted to, so it wasn't directly what we're doing, but I did want to talk about that. A bank will say they credit your account and it increases your account. So your account is a cash account and the bank says it credits your account. The bank debits and credits are exactly opposite of what you would do as a business. And there is a reason for that. If you have a checking account at a bank, for you that's an asset and it has a debit balance. It's an asset. You put $1,000 in the bank for your checking account, that's an asset to you. What's that $1,000? When you put $1,000 in the bank, your checking account to the bank, is that an asset or a liability to the bank? It's a liability. Very good. It's a liability to the bank. When you go in with $1,000 and give the $1,000 to the bank, and the bank has your checking account, that checking account of yours is a liability for the bank because they owe you $1,000. So when they increase your account, they credit it because it's a liability. When you take money out, they're going to debit your account to reduce your account because, again, your checking account at the bank is a liability for the bank. So when you think about when the bank sends you a statement and say we've credited your account, increased it, we've debited it for the service charge, decreased it, that is because it is a liability to them. They are telling you what they did from an accounting standpoint, that this is a liability. But since it's an asset for you, it's exactly opposite. So that's why that seems weird that it's backwards. Okay. Well, there you go, Samantha. Okay. So thanks for the question. It's something that I usually get and I haven't addressed it before this. So if the questions that had been recorded in the books, the question would be correct. No, the question, let me go back to it. Okay, so let's go back to this question. I just want to dwell on it. Every adjustment on the bank side of the bank reconciliations needs to be recorded in the books. No, the adjustments on the bank side have to do with deposits in transit and outstanding checks. Both of those items have already been recorded. A deposit in transit is a deposit that I've recorded in the books, I've taken into the bank, but they're not going to credit my account until the next day because I made it in after the cutoff for accounting purposes. Outstanding checks are checks I've written and recorded, but the bank they haven't been cashed yet, so the bank doesn't have them yet. We do not need to write journal entries or record either one of those because they are already recorded by their very nature. And then bank corrections, we don't write any journal entries for those because the bank has to fix them. So every bank adjustment is a timing error and does not require recording. Okay, so now on to Chapter 8. Now Chapter 8, we are not doing the whole chapter. We're doing parts of it, and you'll see the homework that we have to do. Okay, so in Chapter 8, we're talking about long-term investments, and part of Chapter 8 can also be classified as short-term. When we talk about the difference between short-term and long-term, short-term is anything that's going to turn into cash within a year. Long-term is more than a year. So there's some overlap. But we're talking about investments. Investments can be equity securities. Equity securities are stocks that we own in another company. So if I'm Woody Corporation and I own Amazon stock, that Amazon stock is an investment for me. I can also own bonds. Okay, so bonds, there are two parties to every bond. A bond is a promise to pay. So we have a bondholder who has an investment in bonds, which is an asset, and earns interest revenue, and we have an issuing corporation, which has a bonds payable or a liability and interest expense. We're pretty familiar with stock because we can envision we buy Amazon stock, we buy Target stock, we buy Apple stock, all those things. Bonds are a little more foreign to us because they're not usually offered to the public. Bonds are where a corporation goes to the market and says, here's my IOU, I'll pay you at the end of this period of time, and I'll pay you interest in the meantime. So it's like borrowing from the market. So Solar City, I have the logo up there because Solar City did something kind of unusual last week. Solar City is a company in the United States, and what they do is they install solar systems in homes, in businesses, in other organizations, nonprofits. They install solar systems for electrical savings and for greener energy. So Solar City, what they did last week is they issued $200 million of bonds. $200 million of bonds, what they're saying is that we want to borrow $200 million because they want to expand their operations and they need more cash. So they need to borrow the $200 million. So instead of going to the bank, because the bank tends to be the most expensive source of funds, so instead of going to the bank, they go to the market and they issue these bonds. And what they're doing is they're issuing their IOU, and investors give them money instead. But why Solar City's $200 million issue is so unusual is most bond issues are done in big denominations. Like a bond would be $10,000 or more, and that's the denomination. And bond issues are typically underwritten by the big stockbrokers, and the underwriters sell to large institutions like pension funds and mutual funds. So as an individual, if I want to participate in a bond issue, I'm going to buy a mutual fund bond, a bond mutual fund, okay, because these denominations are usually too big. What Solar City did last week with their $200 million is they issued bonds in $1,000 increments so that individuals could purchase their bonds. So they're marketing their bonds to the general public. This just isn't done very often. You can go to Solar City's website, you can go and look at their solar bonds, and they're offering these solar bonds for sale, for investment. And they offer them with 4 different maturity dates. The first one is due in a year, and this bond pays 2% interest. So if you gave Solar City $1,000 and said, I want this 1-year bond, they will pay you 2% interest. They'll pay you half of that in 6 months and then half in the next 6 months. And then at the end of the 1 year, at the maturity date, they will give you $1,000 back. Okay, so that's one bond. They have one that's due in 2 years and one that's due in 3 years. And then they have one that's due in 7 years. So it has a 7-year maturity and it pays 4% interest. So you could take your $1,000, go online with Solar City, say, okay, here's my $1,000. Okay, so Solar City issues you a certificate. Typically, I don't think they're actually issuing certificates, but you have proof if you've given them $1,000. So they use your money and they'll pay you 7 or 4% interest. Actually, it's 2% after 6 months and then 2% next 6 months. So a bond interest rate is always an annual rate. So 4%, bonds pay interest every 6 months, so you get half the interest in 6 months, half in the next 6 months. So you get interest every 6 months for the 7 years. At the end of 7 years, you'll get your $1,000 back. So the reason this is so noteworthy is they're marketing to the general public, and usually bonds don't go to the general public. But SolarCity wanted to do it to market themselves because they have this green initiative, but they also felt that they could get their money a little bit more inexpensively by marketing to the general public. Perhaps when they went to an underwriter, the underwriter wanted a greater percentage, or they wanted a bigger chunk of it. So they're marketing to the public. But that's what a bond issue is. It's a corporation giving you an IOU. SolarCity, by the way, you can also buy their stock. If you buy their stock, you give them money. They give you a certificate. The difference with stock is they don't pay you the stock back. It doesn't have a maturity date. You own their stock certificate until you sell it to someone, and then you may or may not get dividend revenue from it. They might pay dividends, they might not. That's a policy decision they make. But a bond will pay you interest, and a bond will pay you back at the maturity date. Okay, so there's two parties. We have an investor who's the bondholder, and we have the issuing corporation. The investor, the one that buys the bonds, has an asset, and that's what we're looking at in this chapter, are the people that go buy the bonds. Then on the other hand, the other side of it, we have the issuing corporation, and this is the one that has the liability, that's actually buying, getting your money, keeping your money, using it, and then paying you back at the maturity date. Okay, so we're going to do a question on learning catalytics right now. Okay, in our question on learning catalytics, Woody Corporation purchased a $1,000 bond issued by SolarCity. Woody Corporation has a what? An investment, an asset, or B, a bond payable, a liability? Woody Corporation purchases a $1,000 bond issued by SolarCity. Woody Corporation has a what? An investment or a bond payable? Have about 5 seconds. Okay, last chance to get your answer in. Okay, the Woody Corporation purchases a $1,000 bond issued by SolarCity. Woody Corporation has an investment, so they have an asset. SolarCity has the liability. Okay, so now we've got some pages of notes here coming up here, some vocabulary and some classification. So we said that we can have equity securities, which are stocks, or we can have bonds, and these are investments. So we're looking at it from the standpoint of the company that goes out and spends the money, gives the money to someone and gets equity stock instead, or gets a bond. So one classification we have is available for sale investments. These can be debt securities or equity securities. When we buy them, we record them at cost. We have two categories of these kind of investments. Well, there's three, but two in this chapter. We have available for sale, which is just intention. We plan on selling these when we need to. So we might hold them for sale thinking when we need cash, we'll sell them. We have other security like bonds we might hold that we say we are holding this until maturity. This is such a fabulous investment. We're never going to get rid of it. We're going to hold it until it matures, and that's in the held to maturity category that we'll talk about on Wednesday. But right now we're talking about available for sale. The difference between the two is our intent. Okay, so our intent and available for sale is they're sitting here, and when we need cash for whatever reason, we will sell them. So that's our intention. So when we buy these investments, so when we invest in the stock or we invest in the bonds, we record them at cost on our books. Now, generally accepted accounting principle says at our balance sheet date, then we need to adjust them to something called fair value. Fair value is current market value. So we come to the end of the year, we look at what we bought it for, we look at what it's valued now, and we make an adjustment. And that's what we're going to do in these next several slides, is look at those adjustments. Before we get there, a little bit of terminology. The investor is the entity that owns the stocks or bonds. The investee is the entity that issues the stock, and the debtor is the entity that issues the bonds. So Solar City, if they're selling bonds, would be a debtor. If they're issuing stock, would be an investee. Woody Corporation buying either of those is known as an investor. When we report these investments on the balance sheet, they can be either short-term or long-term. Short-term are current assets, and the intent is a year or less they're going to turn into cash. So for something to be classified as current, the intent has to be it's turning into cash within a year. What we're doing now is we're going to go through an example of purchasing stock, of receiving dividend revenue, and making an adjustment when the market value is different than the cost. So we're going to go through this example here. Okay, so available for sale securities. Now we've got 3 or 4 journal entries. All 4 are good ones to have for a reference. Okay, they're not going to change. Our example is Intel purchases 1,000 shares of Hewlett-Packard common stock at the market price of $44 per share. Intel intends to hold this investment for longer than a year and therefore treats it as a long-term available for sale security. Sometimes you'll see available for sale security abbreviated as AFSS. And so when they go to record this purchase, so we've seen this in a prior chapter. This journal entry isn't necessarily new. But when we make this purchase, we're going to be debiting the investment because that's what we're getting, and crediting cash. And how much is it? We purchased 1,000 shares at $44 a share, so $44,000. So we're going to have the investment. This is our asset. It's increasing. We're going to debit it for $44,000, and we're going to credit cash for the $44,000. So that's to purchase our investment. So that's to purchase an investment. So we purchase an investment, we record it at cost. That's what we've done here. We simply said, oh, this is what it's worth, so we record it at cost. Now this investment can pay dividends. So let's say, for our next example, we receive a 20-cent dividend. Well, 20-cent dividend times 1,000 shares gives us dividend revenue of $200. So we're receiving cash. So 1,000 times 20 is $200 cash, and the dividend revenue is the credit. So those are the two pretty basic journal entries we have when we're dealing with investments. We can purchase it, and we can get dividend revenue. Okay, now, generally accepted accounting principles says we've recorded this investment in the last, when we did the first journal entry. We recorded this, it's sitting on our balance sheet at $44,000. We bought it for $44 a share. So now if the market value, when the market value changes, and it's the end of the period, we need to value that at something called fair value. Okay, fair value adjustment. We're going to put the adjustment into an account called allowance to adjust investment to market. So we're going to take the original cost of the investment and either increase it or decrease it by the amount of the change. And we're going to see this on the next slide. Fair value is current market value. So when we talk about fair value is an accounting term. We always talk about fair value. Fair value is current market value. So now going back to our Hewlett-Packard example, we bought the stock for $44 a share. And so we spent $44,000 on it. Now let's say it's our balance sheet date, and that stock is now worth $46.50 a share. And so our total investment is worth $46,500. So let's say, okay, so we have the quoted market price of the stock is now $46.50, meaning the total value of that common stock is now $46,500. So that's the assumption. So this is balance sheet date. So what we need to do is we need to recognize that our stock has changed, the fair value has changed. Whether it's a gain or loss, unrealized gain or loss, we look at the original cost. The original cost is $44,000. Now it's worth $46,500. So we have an unrealized gain. So what we're going to do here is we're going to debit our allowance, because what we want to do is we want to increase the investment. So we'll debit our allowance to adjust investment in our available for sale security to market value, and then we have an unrealized gain on this available for sale security. And the difference between what we spent, we originally spent $44,000, that's our original cost. It's now worth $46,500. That difference is $2,500, so that's our unrealized gain. Okay, so we have this allowance and we have the unrealized gain. The word unrealized, we had this a few chapters ago. The word unrealized is a trigger to you when you see unrealized that we have not sold that investment yet. So when we pick up a balance sheet and we see something that says unrealized, it means it hasn't been sold. Okay, so when we talk about this, what's happened, if the fair value declines, we have an unrealized loss. If the fair value increases, we have an unrealized gain. This is an either-or thing. So when you look at an investment, it increased in value or it decreased in value. So you either add the gain or subtract the amount of loss when you get that to get the value of your investment. Now the difference, like this journal entry that we just did back here, yep, there, this one. The 2,500 unrealized gain on investment, that's not part of net income. That's part of something in the oval there, reported as an element of other comprehensive income. Other comprehensive income is a special section on the income statement. It's not part of net income. If you're an accounting major, you'll go much deep into depth on that. For our purposes, that's all you need to know. It goes into OCI. It's called Other Comprehensive Income. So it's not part of regular net income. We don't want to mislead investors with these unrealized gains and losses. We want to make it very clear that we actually don't have that gain or loss. It's just a shift in market value. So what we see then, so let's go back to our Hewlett-Packard example. So we said that we bought it, the total that we bought it for was $44,000. That was its cost. At balance sheet date, it was worth $46,500. So we have a $2,500 unrealized gain. So let's now assume that it's now 2015 and we sell the entire investment for $43,000. Okay? So when we go to sell an investment, we have two adjusting entries we need to make. The first one is to get rid of that unrealized gain or loss we've already recognized. So to do that, we completely make the last journal entry backwards. And I want to point out on this one, this allowance, I ran out of space here. So right here, this would be indented. It's a credit. It was just a matter of running out of room on the slide or changing the font to really tiny. So that allowance to adjust investment, it is a credit, so it would be indented normally. So the first thing we do is completely make that unrealized journal entry we made, just make it backwards. Flip it, because we're wiping it out. When we see unrealized, it means we haven't sold it. Well, we've sold it now, so we need to get rid of unrealized. So the first entry here is we're getting rid of the unrealized because we've now sold it. So we need to get rid of what we had done before. So we just take the prior entry, flip it around. Okay, so to sell this, we sold it for $43,000. So we're going to get $43,000 cash. So what we're doing is we're going to debit cash for $43,000. We need to credit the investment for $44,000 because that was its original cost, and then the difference will be a gain or loss. So, okay, cash, $43,000. Okay, we're getting cash of $43,000. My cost on it was $44,000. So I have a loss of $1,000. Okay, so we're going back to the original cost. Spent $44,000 on it, getting $43,000. We lost $1,000, so we have $1,000 on this sale, and then we'll credit our investment for the $44,000. So the credit is for the cost. The cash is for the cash that we're getting on the sale, and then the difference between the two is gain or loss. And it goes on the side that you need to balance it. Make a note. Yeah. The reason we need to make a first entry is if we sold it, we no longer have an unrealized anything. So we get rid of that. When we see on a balance sheet, we see a loss or gain and it doesn't say the word unrealized, that means we have sold it. If you see the word unrealized, that means we still own it. What we're going to do now is we're going to do another Learning Catalytics question. Okay, we've pushed it out. Unrealized gains and losses from available for sale investments arise from what? Where do we get unrealized gains and losses from? What event? Yes, regardless of whether they had a gain or loss, you have to, once you sell it, you have to get rid of the unrealized portion. Brian, it was worth $46,500 at December 31st. This is later in 2015. The value fluctuates, and when they sell it, it's worth $43,000. You may need to sell it because you need the cash now, or you think it's on the way down further and you don't want it to get any lower. So that $46,500 was the end of the year. Now the $43,000 when they had the sale was sometime later in the next year. Okay, there's a question out in Learning Catalytics right now. Unrealized gains and losses from available for sale investments arise from what? The purchase of an investment, the sale of an investment, changes in the market value of the investment, or management's decision to adjust the value of the investment. You have about 5 seconds left to get an answer in. Okay, there is a question in Learning Catalytics right now. We just have a few people who haven't answered yet. So you have 5 seconds from right now. You're the keeper of the time, Haley. Okay, the answer on that one is C, changes in the market value of the investment. Unrealized gains and losses come from the sale. Realized gains and losses come from the sale of the investment. If you see unrealized, it means the market value has changed. If you see just gain and loss without the word realized, it means we've sold it. The assumption is unless it says unrealized, it's sold. Okay, now this is the point where we got to in the first class. I don't want to be off from them, so we are done with material for today. So on Wednesday, we'll finish up Chapter 8. I don't think we're going to have a ton of material for Chapter 8, so we will certainly, it'll be a good pace class on Wednesday. So see you Wednesday.